You're listening to Don't Waste Water.
Some of it are trying to reinvent the laws of nature. It's quite fascinating for people to believe that the holy grail is to create something from nothing at no cost and no energy. To us, it doesn't balance. And when we look at a deck, we need to look at how much does it cost? How much does it return? It's almost mathematics, right? And sometimes the whole science is missing. And when there's no science, you don't know where to look.
Hello, bonjour, and welcome to the Don't Waste Water podcast.
The biggest challenge is time. The industry is a little bit adverse to innovation, and it seems that it takes forever to adopt a new solution.
I'm your host, Antoine Walter, and in today's episode, I'm delighted to welcome Simon Olivier as my guest.
The water issues are way bigger than the energy issues. When you think of it, water fuels more of the industry than oil and gas. Then with that in mind, it leads to, yes, you should take bigger bets in terms of dollars in the water sector, but to do it in a very careful way, because it's a long-term game.
Simon is the head of the Cycle H2O Water Fund and a senior partner at Cycle Capital.
Being an impact fund, if we don't solve the problem at the freshwater level, ultimately is going to end up in the ocean.
The Cycle H2O Fund invests in innovative companies that rethink water usage among its largest consumers, the municipal, industrial, and agricultural sectors.
What we're banking on is that right now, water is being undervalued, i.e. underpriced, globally, and that variable is going to tend to grow just because of pure market fundamentals and market imperatives. More people, more industrialization, more urbanization with a finite resource, then value is going to go one way and it's up.
And before we start, let me thank my sponsor, Simple Lab.
How many will you allow to go to zero? Probably 2 or 3 will not make it at all.
You may not have heard of Cycle H2O yet, but if that's the case, you're missing out on a major shift in the early-stage water tech landscape. And don't worry, that's why we're having this conversation with Simon today. Indeed, over the past few weeks, Cycle H2O invested in BioAlert, Regeno, Aquamembranes, and EcoFilter Tech, which instantly propelled this Canadian newcomer that welcomed me in their offices into the top tier of early-stage water tech investors for 2025. More, they are about to announce the final close of their fund. I believe it's expected for this week, with $30 million ready to go and support innovative water tech companies. I'll do my yearly roundup of early stage water tech deals next January, but if you've been around for the previous editions, you know that 4 out of 5 early stage water investors cut one check and never come back. A different way to say that repeat investment is rare. So, of course, 4 investments in 4 different companies within 6 months instantly puts you on the same table as Burnt Island Ventures, Pure Terra Ventures, Emerald Energy Ventures, or Eco River Capital, a select club of specialists that Cycle H2O is now joining. But I believe that Simon's origin story makes this even more interesting than just another VC announces investments. Indeed, he didn't come from water. His roots are in water's cousin, often looked up as a predictor of what's happening in the next 8 to 10 years, energy, specifically some decades at GE, building the renewable energy business from scratch when, as he says,
our early friends were some tree huggers.
He bought Enron's wind assets in 2001. He watched solar go from fringe to mainstream, and now he's betting that water tech is gonna follow the exact same arc, except with higher stakes. Because, as he puts it again,
the biggest difference between the energy sector and the water sector is the fact that in the water sector, there's no substitute.
So today, Simon walks me through Cycle H2O's unique 3-headed fund structure, himself, H2O Innovation, and Cycle Capital Management, that allows them to de-risk early-stage bets in ways non-water specialist VCs can't. We go deep on their investment thesis, B2B only, technology-driven, and laser-focused on industrial water users who will pay for solutions because it's about business survival, not just compliance. We also get into the nitty-gritty of how they evaluate companies with, for instance, his quick no checklist, why they're seeing down rounds in the market, and what separates a fair valuation from a good one. Spoiler, it involves mapping the exit before you cut a check. And if water adoption takes forever, how do you actually compress timelines without breaking companies? Can water really deliver venture returns if the market has a reputation for 12 to 16 years slugs? What does copilot investor mean in practice, and where's the line between helpful and controlling? What's the difference between a great water solution and a great water business built around business continuity? When PFAS is, and I quote, a tremendous hype, how do you invest without getting sucked into overvaluation? And maybe in conjunction, why does Cycle H2O avoid startups too much dependent on policies and regulations, even in a sector famous for regulation? What's a Goldilocks valuation, and why should founders care if they want to avoid down rounds later? Simon answers all of this and more, so if that's of interest, make sure to stick around until the end. If it's your first time here, welcome to the world's #1 water tech and water finance podcast. Consider subscribing, and I'll meet you on the other side. Hi, Simon. Welcome to the show.
Thank you, Antoine.
I'm super happy to be in your offices today because we bumped into each other at WebTech last year. And you told me, you know what? I'm starting a VC fund out of Montreal. You should look into what we're doing. I was like, okay, I should do that. And in between, you closed your first fund, you made your 2 first investments, and I got teased that there are more in the pipe. But you can't reveal what you can't reveal. So that's not what I'm asking here. But I'm super curious. And the obvious to me first question is, why a water VC?
That's a good question, especially based here in Montreal, Canada, where we're fortunate to have the most fresh water in the world. We've got 20% of the world freshwater reserve right here in Canada. And the rationale behind it is it's all about stewardship. Then when you look at how fortunate we are to have all those water reserve, we own the right to really do something about it and to innovate. And the best way to own your destiny is to build it. We looked at all the issues in terms of water access, water pollution, and there were a lot of different solutions being worked on, which is the good news. But the bad news is the charter banks and the other institutional investors were not comfortable in funding those solutions because of the perceived risk. The first answer, Antoine, I got was, Simon, what are you talking about? We've got plenty of water, and furthermore, water is free. Then we had to really fight those paradigms to really talk about water as a business. And the minute people understood that, the idea really took place and we started getting traction and momentum in the marketplace. And people said, wow, what a brilliant idea.
But still, water being an investment thesis is one thing. Water being a VC field is something else. You're a bit more down the line from the pure players because now there are some pure players existing, but it's still some, and you can count them on the fingers of one hand. So it's still a leap of faith to say that not only is water investable and water companies and water tech investable, but it is so at an early stage. And that's why I can kick off a venture capital thing and give my LPs a return in 10 years. So what nudges you to be on that early stage?
Probably is my age, and I'm fortunate to be old enough to have a track record and to have experience that where and when you can add the most value and you can have the most impact is at the early stage side of things. That being said, it's the most risky side, and in the value chain, it's the most risky space to be in. But that's how we structure the fund with a strategic partner and a strategic investor and partner to really de-risk our early stage investment. In my view, it was clear that if we wanted to have an impact, we had to be early stage and monetize our investment. And to de-risk our value proposition, we decided to innovate on the fund structure and join forces with a strategic partner, H2O Innovation, Inc., and with a really experienced and expert in the investment side, which is Cycle Capital Management. With those two partners on board, it helped us to de-risk our investment thesis and to play at the early stage where I feel there is the more impact for investment.
I'd like to understand the way you work with the 3 GPs, which you just named. So yourself, H2O Innovation, and Cycle Capital Management. What is the role of each of those 3 in the fund's life?
Cycle Capital Management brings all their track record, expertise in managing and leading an early stage fund. Cycle Capital is the largest Canadian clean tech venture capital firm. They've got a track record and proven results to really help us to be the best at what we do. The other one, H2O Innovation, is in about 75 countries around the world. They play on the industrial/municipal side of things, and they bring the best market intelligence and the know-how to really help our investments. They help on the due diligence side to say, hey, this is a good deal, or maybe this is not as good deal as you think it is. And number two is once we've made the investment, they're a catalyst to accelerate the growth of our investees, portfolio companies, by opening doors, coaching them, helping them. The biggest challenge, as you know, in the water industry is time. The industry is a little bit adverse to innovation, and it seems that it takes forever to adopt a new solution. H2O Innovation can really help on that front to not only de-risk, but also to accelerate time to market to make sure that they make access to pilot project and scale up their company.
I have been talking regularly with people on that microphone who told me water is the distant cousin of energy. And if you know how energy works, then you have an edge in water because you know what energy is done 10 years ago, 9 years ago, 7 years ago. Then you know what's happening in water. And then I looked at your track and I'm thinking, maybe you know the future. So what's the story there?
That's a good question. And my background, I spent 30 years in the corporate world, mainly with General Electric, with GE. Started off in finance in the 90s with GE Capital. But quickly, I got adopted by the energy sector, specifically the renewable energy sector, which, as you can remember, in the early 2000s, was not mainstream at all. Our only friends were some tree huggers. We bought Enron in 2001. And then I got a call from HR saying, hey, Simon, you're an engineer. You know about finance. Would you want to lead that business for Canada? I started asking questions and I got stopped right away. Said, we don't know what it is. We don't know which way the blades spin. We cannot answer any of your questions. You just need to tell us yes or no. Then leap of faith, I did say yes. And I ended up leading that business initially in Canada, but a few years after across North America. And it started off with wind, but quickly graduated into solar, biogas, and other renewable technologies as well. And I did that for over 10 years with GE in the early days. And after that, I grew up into GE Ventures and other groups, then very, very intimate with the energy sector. That led me to where I am today on the water side. And you're right, close cousin. There's such a strong water energy nexus. That's what we're learning and seeing now happening in the water side, what happened in the energy side about a decade ago.
I had actually that conversation, especially with Prakash Govindan from Gradient last week. He was disagreeing with me in saying that we should be more aggressive and that's exactly how the energy sector did it. And as a result, from tree huggers, it went to mainstream. In your own experience, do you think we could do that in water and be even more aggressive in this bets we do in the early stages of water tech and get the same results as renewables had? Or are there some lessons to learn from what has worked and not worked in that energy world?
That's a good question. I'd say the biggest difference between the energy sector and the water sector is the fact that in the water sector, there's no substitute. If I look back at my career with GE, we spent billions of dollars to invest in energy substitute. Then renewable and wind initially substitute oil and gas, coal, same thing with solar. Then it was always a matter to find better alternative substitute to the status quo. In the water sector, there's no substitute, meaning that the risk or the stake are even higher because if you get it wrong, you don't have any backup plan. Then that's why you need to be a bit more conscious about how you do it. But the fact of the matter is the water issues are way bigger than the energy issues. When you think of it, water fuels more of the industry than oil and gas. Then with that in mind, it lead to, yes, you should take bigger bets in terms of dollars in the water sector, but to do it in a very careful way because it's a long-term game. Energy is about finding the best alternative, the best substitute. In the case of water, you don't have substitute. The stakes are higher, but the outcomes are even bigger.
Let me thank today's sponsor, Simple Lab. Indeed, testing water and everything around it should be simple. With Simple Lab, you choose what to test, from drinking water and wastewater to soil, air, food, and surfaces, and they handle the rest. Kits arrive at your door with free round-trip shipping, samples go to certified labs, and results come back fast, concise, and actionable. Trusted by leading brands and growing teams, Simple Lab offers hundreds of ways to better understand your environment. Get started today at gosimplelab.com. It's the first link in the description. Thanks Simple Lab for supporting my work, and back to me.
It's interesting because we could discuss and argue if your first investments in Cycle H2O are water plays or energy plays because they play on that intersection, but we'll come back to that. Before that, I'd like to understand the way you see the path through Cycle H2O, because you had a first close at 25 and your investment thesis is to invest checks between $500,000 and $2 million. So how many companies do you intend to bet on in the next years, and what is your time spent for investment?
We're looking at having at least 12 companies in our portfolio to have a good diversification. And the time frame is the first 4 years of the fund to name, find, and deploy in those dozen companies. We're going to keep some money for follow-on investment. That's going to happen year 4, 5, and 6. But after the end of year 4, we're going to have at least identified all our first investment of our portfolio. We're fortunate enough to have a very strong pipeline, and we've built a strong ecosystem of partners with incubators, accelerators, and we're tracking about 400 companies in our pipeline right now. Not all created equal, if you will, but there's a good chunk that are investment ready and that we're currently tracking.
So let's discuss your investment thesis first. Water is broad, and I'm pretty sure your investment thesis is not just water in a hippie fashion. What specific sections of water will you be investing in, and why did you pick those?
Given that we're an impact fund, we decided to target the largest water users in the industry. The industrial sector, manufacturing, food and beverage, mining, energy, everything that is industrial related. The second one is the agriculture sector, which consume tremendous amount and very fast growing amount of waters. And the third one is really the utility/municipality sector, which is not really a consumer, but that's an enabler. Lots of water goes through municipality and utilities, and we think we can have an impact there. Then those are really the three big sectors. What we've excluded is the whole domestic residential side of the equation, because we're really a B2B. We're not a B2C.
I see.
Then everything related to your shower head, your sink, your toilet, we don't do that. And from a technology point of view, we're looking at three elements. We like to think in threes, right? It's really the decontamination, then to look at water pollution and how to improve water quality. The second one is related to water efficiency. Then you can include digital, which is a tool part of that, but the aim there is to make the industry more efficient. As you know, there's a lot of leaks, there's a lot of bad water usage, that we're trying to improve that through technology. And the third one is to look at alternatives. And as you know, right now, the two main ones is desalination. And the other one, which is a big deal, is water reuse, what we call recycling. Right now, as you know, water is a finite amount, and we need to find new ways or new sources of water, and to go from river, lakes, aquifers to alternative sources, which is desalination and water reuse, which we're betting a lot on that at the moment.
So water quality, bettering the water quality, water efficiency, and then new sources of water with a special focus on water reuse.
Correct.
Those would be the three areas across the three main users, but focusing on the B2B element of it.
Exactly. Good summary.
Water technology, or also water services, water projects, or really the technology itself?
It's mainly technology, I would say. Then we love companies, startups that have a good product market fit, but with some barriers to entry as well.
I see.
That includes IP, that includes some trade secrets. And as an engineer, we like technology, but it's got to be technology driven as a solution to the water industry.
You mentioned your 400 companies in the pipeline. How do you build that pipeline, and what's your criterion to at least being on the watch list?
We think that water is a team sport. Early on, we signed partnerships with incubator, accelerator.
Can you name some?
Yep. Cycle Momentum, which is the leading Canadian clean tech accelerator. There's WaterNext, then based on the West Coast through Foresight. There's Mars, there's Aqua, which is based in Ontario. And even we're looking at the Ocean Supercluster, the Canadian Ocean Supercluster based in Eastern Canada, because our view is being an impact fund, if we don't solve the problem at the freshwater level, ultimately it's going to end up in the ocean. That's why we've really worked on a broad ecosystem of partners, but also other funds, some of which are water specific, and some other that are more journalists that wanted to have the water expertise to really de-risk their investment decision. There's the usual suspect on the water side. There's Burnt Island Ventures that we've collaborated from the early days, Mazarine Ventures. There's Echo River Capital. And then there's a bigger one like Emerald, there are HG Ventures and other bigger groups.
So really all the usual suspects expect Pure Terra Ventures because you don't like the Dutch.
I know we like them, and we've looked at some deals together in Pure Terra. And the list goes on and on and on. And I apologize if I've missed some. But of course, water industry is a big industry, yet a small industry at the same time. But we've been fortunate to really establish ourselves as a credible player with those other funds. But also we're talking with strategic players as well. Some of the big publicly traded companies being experts in the water sector. And we talk to them on a regular basis, provide market intelligence, which is a big need for them to make sure that they stay abreast of what's happening from a grassroots point of view innovation. And we're having those discussions.
You mentioned a couple of times that you're an impact fund. So now if I'm playing devil's advocate, that means that you're a tree hugger and you don't want to make too much money because impact first.
Yeah, I'm not sure if it's a question or a comment, but...
No, it's neither nor. It's provocative for you to tell what it really is.
Yeah, they really go hand in hand. Then when you look at the returns and when we talk to some of our investors and you look at their ESG agenda at board meetings, before impact was probably the last item on their board meeting agenda. Now it became number one, especially for water points of discussion, because water, yes, provides impact, but it's all about business continuity. When you think at how much water impact the bottom line, the financial bottom line of a company, it's tremendous. Then people now treat it as impact, but for business reasons. That's why it's clear for us that both impact, environment, and financial returns go hand in hand. And when you look at the current multiples right now in the water sector, and you look at what kind of environmental impact it delivers, it really goes hand in hand. And we've seen that. And the first two investments we've made provide clear financial returns and also excellent environmental impact. And for us, it's not even a question. It's just a matter of what the industry and the purpose and the impact of water does, both financially and environmentally.
On that element of financial returns, what is your aspiration? The reason I'm asking is if you're aiming at 100x, you have to push your companies in a certain fashion, which means you are much more ready to take zeros because you're going to supercharge them and not everyone can survive a supercharge. If you're aiming at a 10x, that means less annual rate of return, but it also means you're going to get less zeros and less risk. What is your strategy here?
The strategy is to really drive the full potential of what the water industry has to give. For us, we look at the fundamentals of the industry and the imperatives. Water being a finite resource with market needs growing globally, something's going to have to give. What is that variable that's going to change is price and value of water. Then what we're banking on is that right now, water is being undervalued, i.e. underpriced globally. And that variable is going to tend to grow just because of pure market fundamentals and market imperatives. More people, more industrialization, more urbanization with a finite resource, then value is going to go one way and it's up. That's point number one. Point number two is we're investing in companies that have scalable solution to those big problems and market fundamentals. The biggest impact or variable, again, that will impact the return is time. How long will it take for those companies to really monetize and scale up their solution? If we invest day one and it takes them 10 years to do that, our return won't be that great. But if we can do that over a shorter period of time, call it 4 or 5 years, our returns will probably exceed any of the other asset class return. And that's what we're banking on. We're banking on to be nimble, quick, and really strategic in terms of time to market and scale to beat any other asset class return that you currently see.
But if I'm the devil's advocate again here, the water sector has this track record of 35 years to be in the middle of the market. And even if you say you don't want to be in the middle of the market, because that would mean you're established with hundreds of references, you could say that you want to be at least in the market with references, and that's 12 to 16 years. So You're trying to compress something which takes up to 16 years to 3 to 4 years because that's what gives you the best return on the investment. When I raise this question to VCs, usually the answer, and I can give you the one from Tom Ferguson, is the entrepreneurs today are of a different pedigree than they maybe were on average 10 or 20 years ago. And we know more. So all those statistics might be true in the past, but they're not true in the future. How do you ensure that you make that difference and that you really pick the winners which are able to beat the timelines?
I think the best answer is to give you an example. We made an investment in a company called BioAlert Solutions.
That's your first investment.
Correct. And what they do is online, real-time, automated water pathogen detection. The first sector that they targeted is Legionella. Legionella, to be able to test, instead of going to a lab, which takes months sometimes to get the result back, they're doing on the spot, real time, few hours, 3-4 hours, in a fully automated way so that you eliminate all the human errors. That solution say, okay, it's a nice to have. If you just watch what happened last week, New York City had a big outbreak. Over 100 people got hospitalized, but what's really worrisome is that 5 people died. Same week, London, Ontario, outbreak Legionella, 2 people died. Right now, the phone of BioAlert is ringing off the hook because of what happened in the marketplace. When I say we're investing in market fundamental big problems, that's an example that from day 1 to day 2, they're going to be able to scale up and leapfrog because they've got a real relevant solution to a major problem, and we're going to scale. The other example is Regional, which does energy transfer from wastewater, mainly in buildings and big industrial application. What it can do is they can extract heat to reheat the incoming water to save on the energy bill. Small startup based here in Quebec, Canada. And recently they were able to sign a commercial agreement with Engie in Paris to really scale up the European market. Then with the strategic value that is being brought to those portfolio companies, we can really scale them up in a very quick manner to really beat the paradigm of 10 or 30 years.
But still, if I take the theory as theorized by Paul O'Callaghan of this timelines of water innovation, he has these 2 categories, crisis-driven and value-driven. BioAlert, crisis-driven. They am fully with you. There's an outbreak in New York. There's an outbreak in London, Ontario. Whenever that happens, people will be wanting that is the last time it happens. And so they might be looking for a solution. And I'm not saying it's easy, but I see how if you're playing your cards right, you can beat the timelines. Regional, awesome technology. I'm an engineer. I love that. I'm a wastewater guy. I love that. I see the perks of extracting the energy and being able to reuse that in a data center context or this kind of stuff. But it's value driven because you can be having another source of energy, another source of something, and then it might be less efficient, but usually if it's not 20 or 30% better, nobody leaves a pan. That sounds more difficult of a path, but if you're ready to take the time, stronger of a moat, because once you're established, then you're good and you're in the right place. How do you balance? Because on your 2 first investments, it's already 2 very different bets, it feels like.
Correct. Hence the diversification of our investment. And on the value-driven side of things, where we think we can add tremendous value is really time to market. As you know, the water problems are so big and numerous, there won't be one silver bullet. There's going to be several solutions to different type of problems. But what we can do in the case of a value-driven investment, we can help open doors. We can help on the go-to-market strategy side of things through the relationship that H2O Innovation has, that Cycle Capital has, that I have, and help them create a market share quick enough to become maybe not the standard overnight, but as close as to the industry standard as a solution. And that's what we can do through distributorship, partnerships, piloting in different geographical regions to really prove the solution with the aim for it to become a standard in the industry.
So what you're saying is that you're a very involved investor. You're not just cutting a check.
We're very involved. We don't have the hands on the wheel. We want the entrepreneur, the founders to really drive the car, but we're sitting next to him. We don't want to be a backseat driver either. Then we're kind of a co-pilot, if you will. We don't make decision on their behalf, but we recommend different options and opportunities for them to decide to really speed up their scale up.
Take me through the process of investing in BioAlert or in Regional. You pick the one which is the more representative. where does it start? How do you build around who invests along you? And what is your vision long term for those companies?
We tend to invest in companies that we already know, that we've known for a few months, some case for years, through the ecosystem that we've built that I was talking about earlier, the accelerator. BioAlert went through the Cycle Momentum Accelerator. Then we knew the individual, which is good because when you invest in a company, it's a long-term relationship. And you need to make sure that you know the individual or the individuals on a very good and strong basis to make sure that you're going to be able to manage a relationship. Then we tend to invest in companies that we've known of for a while and that we've tracked their progression. And then once we feel that the time is right for their next big growth phase, then we come in. We like to be the first check in a company, but we don't invest alone. We create a syndicate of co-investors to make sure that we bring additional capabilities to the investment syndicate. In the case of BioAlert, we brought in investors from across Canada. We brought in an investor from Ontario, one from British Columbia, one from Quebec here, to really make sure that around the table, BioAlert has access to that additional network, in this case, geographical network, to really scale their business. We lead or co-lead the rounds. And in those two initial investments, we ended up being oversubscribed, which is good news for the water sector, water industry. There's a lot of money right now on the sideline, and people are not always comfortable to invest in the water sector just because of lack of knowledge, perceived risk. But having a lead investor that knows the industry helps them get more comfortable and say, okay, well, now we understand it, we get it, it fits our thesis, and we're going to go along with you.
Which sounds to be the right place for me to sneak in the question, which I got from Guillaume Claret yesterday. I asked him what would be a tricky question to ask you. And so here we go. What is the difference between a fair valuation and a good valuation? And what's the definition of each of those two? And what is your intelligence there?
It's a good one indeed. It's what I call the Goldilocks number. The valuation, a fair one, is when the entrepreneur is not happy and that we're not happy. Right? Then that's the place where we feel that we've reached consensus. But in all honesty, what we do is we map it out. Then we look, of course, at the current multiples, but right now there might be hype. Like we look at PFAS. PFAS right now, there's a tremendous hype in the industry that drives what we call like overvaluation. What we need to do is we need to take at least a 5-year time horizon and to map maybe 2, maybe 3 rounds of investment and to look at how does it work out for a potential exit. Then we've got this insight that we share with the entrepreneur and we say, if we start here at point A and you're going to do your next round, let's say in 2 years at point B, that's going to allow you an exit in maybe 5 years at point C. And we're seeing that today, Antoine, in terms of what we call down rounds or bridge rounds. We want to avoid those because they're dilutive, they're not accretive to the company and the investors. Then we want to make sure that we build good value and momentum with the company. To do that, we need to start at a fair point. And that's why we triangulate. We look at where are we today in terms of industry multiple. We look at where do we need to end up in 5 years' time. And what is the roadmap in between? How much money are you going to need? Then if you need X million dollars in 2 years to support that, you need to have created Y valuation to get to that point. And we're transparent and we share that. And that drives really good discussion. But it's always a good way to test the relationship with the entrepreneur as well. I'd say valuation is a good agenda topic to test how you're going to interact in the future. And that's the process.
So you mentioned you look at the current industry multiples. Where do you get those figures? You look at deals and you try to figure out how much equity they got for those deals, and then you have a number?
Yeah, that's one source. And we're privy to lots of deals and market insight. We talk to some of the banks on the more mature deals like Raymond James and others, but we're fortunate to see lots of different transactions in the marketplace. And we really triangulate those numbers and we make our own assessment of what the number should be in 2025 versus what it was a few years ago post-COVID, where the multiples were through the roof. And now people we're seeing are doing bridge or down rounds, which is not accretive to the startups, the founders.
Do you see lots of bridges and down rounds happening right now?
I'd say it's not a majority, but we're seeing some, and we learn a lot from those.
You mentioned that PFAS is a hype at WebTech where we met. 4 out of 5 booths had a PFAS claim. And the previous hype was maybe around hype around micropollutants. Then there was one for dioxin. Then it's a circle. But you see PFAS as a bubble. Like right now, values are through the roof and you should let it settle before you touch it.
It's a good question. We give advice to our startups, and that is one of the advices around policies and regulations. We don't like to invest in a business model that is too much dependent on policies and regulations because those are subject to change, sometimes overnight as a big surprise, and we don't like those.
That's most of the water market. The majority of the water market is regulation driven.
I'm not sure if I agree with that. Yes, in terms of how the water industry is being managed, but not how it's being used. The mining sector, the food and beverage, car auto manufacturer, they're regulated, but their use of water is for business continuity. They need business to operate. Same thing in agriculture. Agriculture is regulated, but at the end of the day, the wastewater is being regulated, but the source water for irrigation and all that is business continuity to them. Then if we can have a more efficient way of saving 10% of their operating costs, they're going to love us. They're going to say, I want it. I want that solution. Then we're really being a B2B. We're aware of the policy and regulations, but we're not investing in what's driving those. We're investing in what's driving good business continuity.
I'm going to quote Amiel Lake here from Carbonet, who told me on that microphone that when they were in the early stages of Carbonet, they looked at the bleeding necks. Not something which is, painful, but okay-ish, but really the bleeding neck. If it's a bleeding neck, then you need to solve it. And that's how you know you have a good business plan. I could see a word where the company is the 400 you have in your portfolio or in your pipeline,
Radar.
not yet portfolio, but the 400 might be rough gems. Stuff where you see, if you polish it a bit like that and you turn it a bit into that direction, then I know those guys have a bleeding neck and I can solve that. How influential can you be on the path of a company? Do they listen to you if you come and say, you're in my pipeline and I'd love to cut you a check, but you would need to do this, this, and that?
The answer is yes. And we're being respected and we've got some credibility in the market space. And we've seen some of the companies do what we call like pivots. When you're an entrepreneur and a founder, one of your strategies is to be opportunistic. Then you're looking at where you can make money. And sometimes they have 2 or 3 markets that they focus on. And we come in and say, if we were you, I would focus on this one specifically for those reasons. And then we shed some light on the future of that company if they were to make that decision. And we do some scenario planning and we help them out. Again, we don't want to decide on their behalf, but we're providing some insight on where the market is headed, how best could it be monetized. And we've got that perspective through our partnerships, H2O Innovation, Cycle Capital, to be able to provide that. When you're a small startup, you don't have access to that. And this is where we bring some value even before investing.
You mentioned how you built your round for BioAlert and how you knocked to some doors and you brought people in and then they ended up for both of them, BioAlert and Regional, being oversubscribed. What is your conversation with those investors? Are they first-time investors in water? And if yes, what do you need to tell them to convince them?
What we have is through our partnership with Cycle Momentum, we've got what we call a circle of investors. It's about 50 players around the world that are part of that circle of investors. This is our proximity, our closest friends, and we make the deal available, at least known to those different investors. Say, hey, we're thinking about investing in this deal. What do you think? In some cases, they're first-time investor, but they look at really the strategic reason, the imperatives of us investing. And if it fits their thesis, then they can come along and they say, okay, yeah, I get it. And I'm interested to play with you. We're fortunate to have this relationship with existing investors that we nurture on a quarterly basis by sharing deal flow.
The reason I'm asking is that if you look at the past decade or so of growth stage water tech deals, you have 1,400, about 82 by my latest count, different investors that cut a check. Out of those, let's say 1,500, that way we round it up because by the time it airs, it's probably 1,500, 84% cut one check and that's it. Meaning that they are invested in water through one single company. But it doesn't mean that it's only family offices that cut one check. It's very often investment funds that cut 60 to 200 checks across industries, but they happen to have just one in water. And what I'm wondering is that a sign of health that we are seen as a diversification play for those guys? Is it a sign of concern? Because that means they take only one little exposure to water and then they might draw conclusions based on that outlier. And is that evolving over time? Because my research indicates that always more people cut one check, meaning you could see the positive, always more people cut water checks, or you could see the negative, nobody comes back.
We're, I think, optimistic by nature, and we see that as positive. The more, the merrier. I think what's going to change, Antoine, is once we start seeing more exits, profitable exits, then it's going to probably drive more mainstream investors to it. Right now, we're at the early days, and the parallel with the energy sector 25 years ago is probably very accurate because when we first started, our only friends were tree huggers, and we would call the Wall Street or Bay Street, and no one would answer our phone. Now, when you look at how many billions are invested in the renewable sector, that's coming in the water sector. That's going to probably take another 5 to 10 years to see more recurrent and mainstream investors. And some are dabbling at it right now, testing the water, no pun intended. But our views is that there is going to be more recurring, and that's going to be driven by more exits maturing in the marketplace.
When I spoke about exits with El Gadebel from Emerald, with DC Ventures, with Pure Terra Ventures, they all tell me it's one of the first discussions they have. They invest in a company, day one of the relationship, they sit down and say, okay, where do you see your exit? Because that's going to influence and inform the path you have to take. I have also seen outliers who tell me we don't do that day one because we don't want to scare them, but we think of it and then it's a process. Where do you stand?
It's really the first discussion. Coming back to your question about fair versus good valuation, exit strategy needs to be part of that discussion. Then we need to be aligned with the funders. Where do you want to take it? Because sometimes people are saying, hey, you know what? I'm happy the way it is. I'm not sure that I see it as $100 million company. I'm not a professional CEO and so on and so forth. Then the exit is a good driver to lead discussion about what is the path forward? What is that roadmap? And then we have those discussions day one. And we have those discussions with strategic partners as well. Big industrial water player say, hey, what do you think about this sector? What do you think about this company? We have those discussions quite early in the process in our due diligence to make sure that we don't end up with a bright, shiny object that we think is valuable, that no one else thinks is valuable. Then we really test it both with the funders and we test it with the market to make sure that we're placing bets that are de-risked day one.
I have a myth or truth question for you. I really don't know. Founders are often afraid to come talk to an investor too early, even not to ask for an investment, but just to say, look, I'm building this and you might want to invest in me down the line. I want you to know that I exist. And they're afraid of doing that because they think, okay, but if they see me in a stage where I'm not ready for investments, they're going to see me as not valuable. And then my shot at fame is gone and they will never invest in me. The same repeats once they got growth money. They shy away from going too close to a strategic because they think if I start telling the strategic, here's what I'm building, and by year 5 or year 6 of that path, we might want to come closer. And they believe, oh, again, that's my shot at speaking with them. And once I've used it, it's gone. So is that a myth or is that true?
I'd say it's true. And we really thought about what you just mentioned. What is the right timing for a startup to reach out to a VC for the first check? Our view is that we like them to come to us early or earlier. And if they're not investment ready, we refer them to our accelerator with Cycle Momentum and say, hey, maybe you need some coaching on how to pitch. You need some coaching how to build your financial model. You need some coaching on your go-to-market strategy. And if we like the gem, as you refer to, that we think the technology and the IP is meaningful and they need stuff around it, then we're going to refer them to accelerators for them to come see us 12, 24 months down the road. Once they receive growth capital, the fact that we've got a strategic H2O Innovation should be seen as a positive because H2O Innovation is really technology agnostic. And that's the reason why we partner with them. We would not have done something similar with a technology manufacturer or someone who's have their own products. But in case of H2O Innovation, there's a lot more positive in their case that the startups, the founders would benefit from in terms of market access, market insight. And they see that as very, very positive.
What's your checkbox to a quick no?
If they don't have any barriers to entry, and I would put IP and patent in that box, it's hard. If it's a Me Too product, which is not highly differentiated, not with a strong value proposition, we're going to say no. If they don't have a clear roadmap to monetization, what is their business model, how they're going to make money, then it's going to be a clear no.
They need to have a roadmap to money, but they don't need to be in the money yet.
They need to have at least some revenue. Paid pilot, at least, several tens of thousands to low hundreds of $1,000s, and to be mature enough. And most of the water startup have been able to bootstrap their funding through non-dilutive money like grants, because there are very few water dedicated investment funds right now. Then that led them or forced them to bootstrap. And the last box, to answer your previous question, clear no. The fourth one is the team. If we feel that they don't have at least the basics, right? Then someone on the technology, someone on the business, someone on the commercial, they have at least some of the key elements of a team. If they don't have that, then we're going to say no.
Is there a specific size for that team?
No size. And when I look at those 4 buckets, it's a combination thereof. Meaning, if it's a one-person company, but with tremendous technology, tremendous IP, tremendous product market fit, we might say yes. Then it's a trade-off between those 4 boxes. But if they all check no, that's a quick no.
And for your 2 first checks, did they check all the boxes?
Pretty much, yes. I'd say, thinking of it now, yes.
What is next?
We're currently working on 3 deals to be closed. And by WEFTech, next time we talk to each other, we're going to have, again, some good news. We're currently looking at what we think is the greatest breakthrough in water treatment through technology. That's a bold statement, and you'll see this shortly. We're looking at a couple deals in the PFAS sector, both on when you look at the value chain of PFAS, you've got detection to know, do you have a problem or not? And how big is your problem? You've got concentration to make sure that if you do have a problem, how do you make it more fixable, if you will, or addressable? And the last piece of the value chain is destruction, so you get rid of the problem. We're looking at, hey, PFAS is a problem. How do you know that you have a problem? How you make it addressable? And how do you eliminate it? And when we're mapping the value chain, we're looking at some solutions or technology. Of course, some of it is driven by policies and regulation, but in the industrial sector, where people, when they look at their balance sheet, they want to avoid that financial risk related to PFAS, because otherwise it could tank literally their business. And then we're looking at how can we address those solutions.
If I take you now to the future, the early days of energy investments were a few pioneers putting some checks, and nowadays Costa Ventures has maybe cut hundreds, if not thousands of checks. Do you see a future down the line in 10, 20, 30 years where you have Fund 12 of Cycle H2O, while Burnt Island is at Fund 17 and Pure Terra at Fund, and each of you have invested those hundreds of checks? Or is it still a specialist play with more human-sized boutique investors, which each 20 or 30 companies in portfolio? Will there be giants or lots of mid-sized investors?
Water tech in early stage investments going to become more and more mainstream, because what I said earlier is that water, given the value and where the price is headed, will attract more dollars. And when you think that water is ubiquitous, and right now people will see the impact of missing good quality water in good quantity, and that's going to drive more investment. Then I see water tech investment becoming a mainstream sector, attracting more dollars by necessity. Right now, when you look at all the different issues that we're facing, accelerated by climate change, that's going to really drive dollars to make sure that as a society, we've got the access to clean and good quality water for business continuity and survival.
And do you see yourself staying in that early stage? Because you're not so distant neighbors of XPV. It started in the early stage.
Yeah.
And they matured in the later stage where now they are thriving.
It's a very good question, Antoine. And Fund 1, we're differentiated because the uniqueness of the fund structure, having 3 partners, Cycle Capital, H2O Innovation, allowing us to de-risk and better monetize early stage investment, meaning taking more risk, but potentially making more money out of it. That's really our moat and our uniqueness in the marketplace, which we'll probably maintain going forward for Fund 2 and 3, that we're looking at staying early stage or earlier stage. We want to avoid getting into what we call the infrastructure play. Then infrastructure is really capital intensive. That's not our play. Our play is technology, innovation, and really differentiated solutions that are scalable quicker. For us, where we play and how we're differentiated is on pure technology, hardware, software at the earlier stage.
And what needs to happen in the next 12 months to keep you on track of that vision of Fund 1, 2, 3 and keep thriving in that early stage?
Couple things. Number one is to keep deploying, and we've got 3 deals right now that we're in the midst of closing. Number 2 is to start reporting early success of our current investments. And number 3 is positioning ourselves for the next deals to be closed, to really have half a dozen investment by the end of this year. And that's going to really help build the momentum for Fund number 2 and for the future.
Out of your 12 aspirational companies, how many will you allow to go to zero?
Probably 2 or 3 will not make it at all. There's going to be 2 or 3 that, to use a baseball analogy, will make it to first base. Then it's going to be a single. And the rest is going to be a mix of 2, 3x with couple exceeding 10x. We're really bullish on 10x is possible and feasible in the sector right now. We enter with that aspiration to all be 10x, but we can afford to have couples that are not making it.
10x? Because when I spoke with Peter Yoles, he was saying 100x is doable.
We haven't seen that many cases of 100x. We've got the benefits of having good expertise and experience on the team to aim high, but we know the market that 10x at the entry level that we're looking at is totally feasible. That's our strategy, is to have more 10x across the portfolio versus one single 100x.
And now if I look longer term, when you're hang your hat and say, that's my last day at Cycle H2O, my last day because I go to a well-deserved retirement, what is your impact?
The impact is going to be on, number one, water being really considered as a strategic asset. Because right now, especially where we live here in Canada, it's still taken for granted, but that is changing. Then number 2, to have created what I call like water stewardship. Then for people, organization, governments to care deeply about the importance of water for now, but also for the future. And number 3 is the impact, both financial and environmental. Financial for a reason to be able to reinvest and to support a company. There's no making money for making money. You need to make money for a reason. And that reason, in the case of water, is to be reinvested, because right now the needs are way over the supply and you need to be able to reinvest. And the return on the environmental impact is really for the future of society. Because if you don't do it now, we're going to get into what I call diminishing returns, and you don't want to get there.
To round those conversations, I have some rapid fire questions.
Yes.
If that's fine with you.
It's time for the rapid fire questions.
What is your number one advice to the about 1,500 water startups?
Number 1 is make sure you've got a very strong product market fit, and people are dabbling or looking at, they want to have an impact, but make sure that you're aiming high to have the best product market fit. Number 2, I would say, is cash is king in today's environment. Make sure you protect cash as much as possible, because we're going through rough waters right now. And number 3 is don't try to do everything alone. Try to reach out, do partnerships. That's the best way to test if you're working on something meaningful. Otherwise, being isolated and thinking you've got the best solution ever, but that is not being tested or challenged by others.
What is the craziest deck you've seen?
We're seeing lots of atmospheric water capture solutions right now, and some of it are trying to reinvent the laws of nature. It's quite fascinating for people to believe that the holy grail is to create something from nothing at no cost and no energy. To us, it doesn't balance. And when we look at a deck, We need to look at how much does it cost, how much does it return? And it's almost mathematics, right? And sometimes the whole science is missing out of a deck. And when there's no science, you don't know where to look.
How do you assess the science?
We look at, are we intelligent enough to ask the right questions? Of course, there's a lot of things, Antoine, that we don't understand when we get the first deck. But does it pique our curiosity and interest so that we can come up with a frame of questions to allow us to better understand? The science is assessed from, do we understand enough of it to be able to ask intelligent questions? But if we cannot even get to framing intelligent questions on our end based on the science that is being proposed, then the gap is way too big and we just pass.
What is the single drop of knowledge that investors in general still miss about the water sector?
I would say is timing. Timing is not created equal in the water sector. There's some solution, especially on the software side, that can be deployed way faster given the people behavior factor. I guess it's two elements to your question. Number one is you really, really need to assess and understand the timing factor of your solution. And the second one is people adoption, people behavior around your solution. You need to have a really, really grassroots assessment of what that means. And sometimes you spend too much time on assessing the technology, the solution, and the financials, and you miss the timing element of it and the people element of it.
Profitability or growth?
Growth. Profitability is the cheapest way of fundraising. When we map out the valuation of the company in the exit strategy, profitability has to play a role in it. And at some point, yes, profitability has to come in play as a mean to fundraise in the most efficient way the potential exit. Then the best way actually is grants and non-dilutive. That's probably the best way by far, fundraising. The second one, profitability. Third one, venture capital. And you need to look at a mix of all three. Profitability has to come in the mix, but as an exit strategy play, not as a day one play.
What is the lowest equity that a founder can go to before it's dangerous?
Good question. It depends on the round. Then when you do the first check, they need to be majority, right? They need to be 50% plus. And then as you go to Series A, it can drop below 50%. You can be in the 40, 35% range. Series B, but you need to, dollar-wise, you need to have them incentivized enough to still drive the right decisions for the business.
What is that tool that nobody speaks about, but you could not live without?
That's a very good question. The best tool, which is access to information, is the market intelligence and insight that is being provided by both H2O Innovation and Cycle Capital, which helps a fund like ours, an early stage, first-time fund, play and act and behave as a large or larger mature fund. The strategic value that they bring allows us to punch way above our weight in terms of market impact.
And aside from those sources, what are your sources for water intelligence?
Water intelligence is talking to startups, those 400 on our radar. That's so insightful. Then we spend time, myself and my associate Carolina, on the phone and in meetings all the time to get that insight, to be smart enough to challenge the current status quo and learn out of it, and not to expect that we know everything, because we don't. At the end of the day, we learn every day. We're curious by nature, and we like that engagement through trade conferences and phone calls to learn as much as possible. And we like to be surprised.
What was the last time you were surprised?
Last week on a company that really want to reinvent the chemical water treatment industry with an innovative ingredient and product that's been proven, but challenged to be adopted, that they think they can revolutionize the chemical water treatment sector.
Well, Simon, it's been a pleasure. What is the best place for people to follow up with you?
It's through LinkedIn, through the website. They can reach out to LinkedIn, Simon Olivier directly, or cycleh2o.com on our website.
As always, look at the description. The links will be down there. That's probably the easiest to be sure to not have a doppelganger of you and to really be on your account. Well, thanks a lot for everything you shared, and hope to see you soon.
Thanks for listening to Don't Waste Water. This podcast was brought to you by GF Piping Systems. Loved this episode? Head over to Apple Podcasts to subscribe, rate, and leave a review. See you next time.